Bitcoin's biggest problem today could become its biggest weapon tomorrow. Right now, Bitcoin miners create 3.25 BTC every block. In 2028, that gets cut in half, 1.5625 BTC. Now imagine that happening while institutional demand is rising. Scaramucci thinks that combination could help Bitcoin reclaim $100,000. He's calling this a bear market. He said that plainly, no sugarcoating. And in the very same breath, he said he still expects Bitcoin to climb back above $100,000. Read that again, a bear market and a six-figure target. Those two ideas are not supposed to sit next to each other, so something else is going on here, and by the end of this video, you're going to understand exactly what that something is. Before we go further, a quick disclaimer. Nothing in this video is financial advice. We are not telling you to buy, sell, or hold anything. This is analysis and commentary for informational and educational purposes only. Cryptocurrency is volatile, prices can move sharply in either direction, and you should always do your own research and speak with a licensed financial advisor before making any investment decision. Quick one before we go further, type in the comments what device you're watching this on right now, phone, laptop, or maybe you've got this playing in the background while you're doing something else entirely. It helps me understand who's really here. And while you're down there, if you're new to this channel, hit that subscribe button because the Wealth Continuum breaks down exactly this kind of market mechanic before the headlines catch up to it. Now, here's what almost nobody's explaining properly. Scaramucci is not pointing to some magical Federal Reserve pivot. He is not betting the farm on new crypto legislation moving through Washington. He is not saying Bitcoin explodes next month. He's pointing at something far more mechanical, far more boring on the surface, and honestly, far more powerful underneath. He's pointing at the next Bitcoin halving. So here's loop number one for you to sit with. What does an event scheduled for the year 2028 have to do with Bitcoin's price today in the year 2026? That gap is roughly 20 months. Why would a market start reacting to something that far out? Here's loop number two. Why does Scaramucci think this particular bear market might actually be healthier than the ones that came before it? And here's loop number three, the one I want you to hold onto the longest. What happens if institutional buyers start moving in before the halving even arrives, not after? Stick around, because we're going to answer every single one of these, piece by piece. Let's start with what Scaramucci actually said, because context matters here more than the headline does. Speaking to CNBC, Scaramucci said he expects Bitcoin to move back above $100,000 as the halving cycle approaches, and new supply keeps getting tighter. That's the core of his argument, not hype, not a moon call, a supply argument. But here's the part that most channels are going to skip right past, and it's honestly the most important part of the entire story. This is not a call for an overnight breakout. Scaramucci reportedly said Bitcoin could grind for a while first. Grind, not explode, grind. That word choice matters a lot because it changes the entire shape of the story. Most viewers hear Bitcoin to 100,000, and their brain immediately jumps to a straight line, up and to the right, rocket ship, done. But that is not what's being described here. What's actually being described looks more like this. Quiet accumulation, followed by supply tightening, followed by a demand imbalance, followed by a potential repricing further down the road. It's slower, it's less exciting on the surface, but it's also a lot more believable, and that's exactly why it deserves your attention. So ask yourself this. If the real mechanism here is supply compression rather than a sudden news catalyst, doesn't that mean the market could start pricing this in long before the halving date actually arrives? Hold that thought. Because we're circling back to it later, and it might be the most important idea in this entire video. Now let's deal with the uncomfortable part. Because right now, Bitcoin does not look strong. It looks tired. The price has been stuck bouncing inside a narrow range for weeks, unable to build any real momentum in either direction. And Scaramucci pointed to several specific reasons why. First, capital has been flowing hard into artificial intelligence investments instead of crypto. Money that might have gone into Bitcoin 2 years ago is chasing AI infrastructure and AI stocks today. Second, even Bitcoin miners themselves have been redirecting computing power toward AI workloads because it's currently more profitable for some of them than mining alone. Third, momentum across the entire crypto market has been weak, not just for Bitcoin specifically. And fourth, if you believe in the traditional 4-year Bitcoin cycle, we are sitting in what would be considered the later, colder stage of a bear phase. Stay with me here, because the next part is where this gets genuinely interesting. Bitcoin has fallen a long way from its all-time high near $126,080, which it reached back in October of the year 2025. At current levels, Bitcoin is trading somewhere around 50% below that peak. That sounds brutal on paper, but Scaramucci looks at that same number and sees something different. He considers this drawdown relatively shallow compared to Bitcoin's history. Previous bear markets, the ones from 2018 and 2022, saw drawdowns in the range of 75 to 80% from the top. This one has been noticeably smaller than that. So here's where the story turns weird, and I mean that in a good way. What if Bitcoin's current weakness isn't actually telling us that demand has vanished? What if it's telling us something closer to the opposite, that demand is quietly soaking up whatever supply gets sold without needing to push the price aggressively higher to do it? Comment below and tell me honestly, does a 50% drop from the peak feel shallow to you, or does that number still feel painful sitting where you are? I genuinely want to know how people are experiencing this correction in real time. There's one mechanism sitting on the calendar that could make this entire imbalance a whole lot more important over the next 20 months, and that's exactly where we're heading next. Let's slow down and actually explain the halving properly, because a lot of people throw this word around without really understanding what it does. The next Bitcoin halving is expected to happen around April of the year 2028, at block number 1,050,000. When it hits, the reward miners earn for confirming a new block gets cut exactly in half. It drops from 3.125 Bitcoin per block down to 1.5625 Bitcoin per block. This isn't a decision anyone makes. It isn't a vote, a policy meeting, or a committee choosing to slow things down. It's written directly into Bitcoin's code, and it happens automatically roughly every 210,000 blocks, like clockwork, the same way it has every single cycle since Bitcoin launched. Bitcoin doesn't need to decide to become scarce. Scarcity is already built into how the system runs. Here's the simple version of the math. Before the halving, a certain amount of brand new Bitcoin enters circulation every single day, and miners typically sell a portion of that to cover their costs. After the halving, roughly half as much new Bitcoin enters circulation each day. The same number of buyers, potentially far less new supply hitting the market to meet them. Less new supply plus the same amount of demand equals a noticeably tighter market. And less new supply plus rising demand on top of that equals the kind of setup that can lead to genuinely aggressive price discovery. But hold on, because there's a serious problem with this argument, and I don't want to gloss over it the way a lot of bullish content does. This is exactly where we separate a real Bitcoin thesis from pure Bitcoin hype. So stay with me for this next part. Here's the sentence I want you to actually sit with. A halving does not automatically make Bitcoin's price go up. I'll say that again, because it matters. Supply reduction only moves price if demand is actually there to meet it. Picture this scenario. New Bitcoin supply falls exactly as scheduled, but at the same time, demand falls even faster. In that case, Bitcoin can still go down, even while it's becoming mathematically scarcer by the day. Price was never determined by scarcity alone. It gets shaped by a combination of supply, demand, available liquidity, and how much risk investors are actually willing to take on at any given moment. Now bring in the macro picture. If interest rates stay restrictive, if liquidity across the financial system remains tight, if investors keep favoring artificial intelligence over crypto, if institutions pull back their exposure instead of adding to it, and if exchange-traded fund inflows keep weakening, then the halving might not matter nearly as much as people assume it will. Here's the line I need you to remember from this entire video. Bitcoin can become scarcer, and its price can still fall at the exact same time. Those two things are not contradictions. They can both be true simultaneously. So if scarcity by itself isn't enough to guarantee anything, what would actually need to happen for Scaramucci's $100,000 scenario to play out for real? That's exactly what we're unpacking next. And this is where they're not telling you the full picture. The real catalyst was never just about supply falling on its own. It's about supply falling while demand climbs at the same time. That combination is the entire ballgame. So where could that rising demand actually come from? Let's walk through it piece by piece. Institutional capital is the first piece. Large institutions don't need to buy some enormous share of Bitcoin's total supply to move the price meaningfully. That's because the amount of Bitcoin actually available for active trading, the liquid supply, is a lot smaller than Bitcoin's total supply of 21 million coins. A relatively modest wave of sustained institutional buying can have an outsized effect on a market that tight. Exchange-traded fund demand is the second piece. Spot Bitcoin ETFs have made it dramatically easier for everyday investors and institutions alike to gain exposure through familiar brokerage accounts, without ever touching a crypto exchange directly. That access alone changes who's able to participate. Long-term holder behavior is the third piece. When more Bitcoin moves into cold storage and long-term custody instead of sitting on exchanges ready to be sold, the amount of coin available for immediate trading shrinks even further, independent of anything the halving does. And corporate or treasury adoption is the fourth piece. Companies and institutions choosing to hold Bitcoin on their balance sheets create a category of demand that has nothing to do with retail speculation or short-term trading at all. This is where the halving in the year 2028 becomes genuinely interesting, rather than just a date on a calendar. Bitcoin doesn't need demand to explode overnight to make this thesis work. It only needs demand to consistently outpace whatever new supply is entering the market. That's a much lower bar than most people assume. Quick engagement question for you. Out of those four sources, institutional capital, ETF demand, long-term holders, or corporate treasuries, which one do you personally think matters the most right now? Drop your answer in the comments. I'm curious how different this looks depending on who's watching. Hit that like button if this breakdown is actually making the halving make sense in a way it never has before. Let's map out the timeline so this feels less abstract and more like something you can actually track. Right now, in August of the year 2026, Bitcoin is sitting around $64,000, well off its all-time high, moving sideways more than anything else. From here, the next phase would likely involve continued accumulation and consolidation, the kind of quiet, uneventful price action that puts casual observers to sleep, but that patient holders tend to pay close attention to. Moving into the year 2027, the market would typically begin looking ahead to the approaching supply reduction, the same way it has before previous halvings. Then, in April of the year 2028, the mining reward gets cut in half, right on schedule, exactly as the code dictates. And afterward, historically speaking, Bitcoin's biggest bull phases have tended to cluster around halving cycles. But I want to be completely honest with you here. Timing and magnitude are never guaranteed. History rhymes, it doesn't repeat on command. But here's what makes this particular cycle genuinely different from the ones before it. And this is where it gets really concerning if you're only looking at old playbooks. Bitcoin is not operating inside the same financial environment it was in during 2016 or 2020. Today, there's a mature spot ETF infrastructure sitting behind it. There's far larger institutional participation than ever before. There's heavy sensitivity to macroeconomic conditions like interest rates and Fed policy. There's real competition for capital coming from the artificial intelligence boom. There's tighter regulatory integration than any previous cycle had. And there's a much more sophisticated derivatives market layered on top of everything. So the real question isn't whether history simply repeats itself this time around. The real question is whether the same underlying supply mechanism still functions the same way inside a completely different financial system than the one it was built for. This next part is the intellectual core of the whole video, so stay with me, because it's the piece that actually ties everything together. The traditional Bitcoin cycle theory looks something like this. A halving triggers a supply reduction, which leads to accumulation, which leads to a bull market, which eventually peaks, which then rolls over into a bear market, until the next halving starts the entire loop over again. Clean, predictable, almost mechanical. But that clean pattern is under real pressure right now. Institutionalization may be quietly weakening it. Why? Because Bitcoin increasingly trades alongside equities, alongside broader liquidity conditions, alongside treasury yields, alongside the strength of the dollar, alongside institutional portfolio allocations, and alongside ETF flow data. Bitcoin is becoming less of a purely isolated crypto cycle asset and more of a macro correlated one. Here's the big question I want you thinking about right now. If the 4-year cycle really is breaking down in front of us, does that make Scaramucci's $100,000 argument stronger, or does it make it weaker? Here's my read on it. The halving might no longer function as the starting gun for the entire cycle the way it once did. Instead, it might become the trigger that amplifies a demand imbalance that was already quietly building underneath the surface, long before the halving date itself arrives. Comment below with your honest take. Do you think the 4-year cycle is dying, evolving into something new, or still fully intact underneath all the noise? I want to see where this audience actually stands on it. Let's give this some real structure, because vague predictions don't help anybody make sense of what's coming. The first scenario is the bear case. Bitcoin stays trapped inside its current range. Liquidity across markets remains tight. Artificial intelligence keeps absorbing the bulk of available investment capital. ETF demand stays weak or continues drifting lower. The halving approaches right on schedule, but investors largely shrug it off. In this outcome, scarcity increases exactly as programmed, but price doesn't necessarily follow it higher, at least not right away. The second scenario is the grind higher. Bitcoin slowly rebuilds momentum over time. Institutional demand gradually improves. Broader liquidity conditions become more favorable as central banks potentially ease policy. The market begins anticipating the year 2028 well ahead of time, and Bitcoin starts climbing before the actual halving event even happens. Of the 3 scenarios, this one lines up most closely with what Scaramucci himself described as grinding for a while. The third scenario is the supply shock, and this is the explosive one. Picture ETF demand rising steadily, institutional demand rising alongside it, long-term holders continuing to hold rather than sell, new Bitcoin issuance falling exactly as scheduled, and overall liquidity conditions improving at the same time. In that world, the market isn't simply buying Bitcoin anymore in the ordinary sense. It's actively competing for a shrinking pool of available coins. And that kind of competition is exactly when price discovery can turn genuinely aggressive, in either direction, but especially upward when supply is this constrained. Which of these three feels most realistic to you personally? Type 1, 2, or 3 in the comments right now. I actually read through these, and I want to know where this audience's head is at heading into the back half of this video. Now let's zoom in specifically on that $100,000 level, because the number itself carries weight that goes beyond pure math. Bitcoin has already crossed $100,000 before, reaching as high as roughly $126,080 in October of the year 2025. So this was never really a question of whether Bitcoin is even capable of reaching six figures. It clearly is. It's already done it. The bigger question is whether Bitcoin can reclaim that level and actually hold it in a sustainable way, rather than briefly touching it and immediately falling back. Here's why that particular number carries so much psychological weight. It's a major round figure that's easy for the average person to remember and repeat. It represents a previous milestone that the market has already lived through once. It could serve as confirmation that the broader cycle has genuinely turned. It's the kind of level that tends to attract momentum traders once price gets close enough. And it's a natural headline catalyst that mainstream financial media loves to cover. And here's the part that makes this genuinely fascinating from a market psychology standpoint. If Bitcoin gets close enough to $100,000, momentum traders don't actually need to believe in Bitcoin's long-term future to start buying. They only need to believe one simple thing, that it's going higher from here. That belief alone, multiplied across enough traders at the same time, can create real reflexive demand, completely independent of anything happening with the halving itself. Here's where this video actually becomes useful to you beyond just entertainment. So stay with me for this next stretch, because these are the things worth tracking going forward. Don't fixate on the $100,000 number itself. Watch the signals feeding into it instead. Signal 1 is exchange-traded fund flows. Are institutions consistently adding exposure week after week, or are they pulling back? Signal 2 is broader liquidity. Are global financial conditions becoming more supportive of risk assets, or are they tightening further? Signal 3 is Bitcoin's exchange supply. Is the amount of liquid, readily available Bitcoin sitting on exchanges shrinking over time? Signal 4 is long-term holder behavior. Are the people who've held Bitcoin the longest choosing to distribute their coins, or are they continuing to accumulate? Signal 5 is miner economics. How does the upcoming halving affect miner profitability? And does it change how much selling pressure miners put on the market to cover their costs? Signal 6 is the balance between artificial intelligence and Bitcoin as competing places for capital. Is money continuing to migrate toward AI, or is it starting to rotate back toward crypto? And Signal 7 is overall market structure. Does Bitcoin begin printing higher highs and higher lows well before the halving actually arrives? The kind of pattern that suggests the market is already pricing something in ahead of time? If several of these signals start turning at the same time, that's when the $100,000 thesis becomes a lot more than just a talking point on CNBC. Which of these 7 signals are you personally going to start paying closer attention to after watching this? Let me know below, because I genuinely think this list is more valuable long-term than any single price prediction could ever be. So let's bring this all the way back to where we started. Is Bitcoin actually going back to $100,000? Scaramucci clearly thinks it can happen. But the real story here was never about that specific number in the first place. It's about the mechanism sitting underneath it. Bitcoin's next halving is expected around April of the year 2028, and it will cut the block reward from 3.125 Bitcoin down to 1.5625 Bitcoin. That part is essentially locked in, written into the protocol itself. But scarcity on its own has never been enough to guarantee a bull market. The genuinely explosive setup requires 3 things lining up together. Supply needs to keep falling. Demand needs to keep rising. And liquidity across the broader financial system needs to keep improving. And here's the line I want you to carry with you after this video ends. If those 3 forces actually collide at the same time, Bitcoin doesn't need every single person watching this to suddenly turn bullish. It only needs enough buyers wanting more Bitcoin than the market is actually willing to sell at that moment. That's the part of Scaramucci's argument that genuinely deserves your attention far more than the headline number itself. One more curiosity loop before we wrap this up completely. If Bitcoin really does start pricing in the year 2028 halving well before it arrives, the biggest single move of this entire cycle might happen, long before the halving itself ever takes place. Something worth sitting with as you watch the charts over the coming months. So here's my question for you, and I actually want a real answer in the comments, not just a number. Do you think Bitcoin reaches $100,000 again before the year 2028 halving arrives? Or do you think this entire cycle is fundamentally different from every cycle that came before it? Drop your honest target below and tell me why you landed on that number specifically. While you're typing that out, one last question for fun. How's the weather where you're watching this from right now? I like knowing where in the world this channel actually reaches. If this video helped the halving mechanism finally click for you, hit that like button. It genuinely helps this channel more than you'd think. Subscribe if you want the next major Bitcoin supply signal broken down before the rest of the internet catches on to it. And if you know someone who keeps asking you why Bitcoin's halving even matters, share this video with them directly. It'll save you an entire conversation. This has been the Wealth Continuum. I'll see you in the next one.